And I'm going to go ahead and get us kicked off just shortly here. But before I do that, let me go ahead and share screen here. Before I fully launch into this, wanted to just give you all a really warm welcome. Thank you all so much for being here. We do these webinars twice a month at least. And so really excited to be able to connect with y'all and offer hopefully some really helpful and valuable resources. Really, the format of these is very conversational, very approachable. And so hopefully what you're able to do here is ask both Mike and Joe all of the questions that you have. This is a really special session because we have, the legal perspective. We've also got, the investor perspective. So it should be a really engaging session. In terms of asking those questions, feel free to put them either in the chat or in the Q&A. I'll be monitoring both so we can answer those in real time throughout the session. And so without further ado, I'm going to go ahead and get us kicked off. Welcome to Maximizing Year-End Benefits, specifically for investors. I'm going to go ahead and kick it off to Mike really quick.
Wonderful. I'm going to cover, Mariah, thank you so much. Thank you for getting us rolling here. What a great way to finish the year. So hopefully we're going to be talking a lot about tax gains and how well people have done and set you up for success in 2024. I'm going to cover our disclaimer, and then I'm going to cover the next slide. We're going to kind of lay out the roadmap for tonight's conversation. And as Mariah mentioned, this is really meant to be a conversation. So we'll have time at the end for Q&A, but don't wait until the end. If you've got a question, a comment, an idea, we really love hearing from our members at the events that we do, at the web events that we do as well. So, fire away and don't wait until the end if you've got a question. Really important disclaimer. I think it's a disclaimer that we use in all of our webinars, which is, if you're looking for specialized advice that really pertains to your particular situation, that's not what this webinar is really for. This is to provide some general guidance, some guidelines, some ideas, some practical approaches that may be helpful, some kind of high level thoughts. I think that'll really give everyone who's on the call or who watches the recorded version a chance to kind of think deeply about different strategies for real estate investing. But we're not your attorney and we're not your tax accountant in this particular case. So, for your particular situation, we definitely recommend that, you reach out to professionals that will really dive into the particular situation that you're in. And there's going to be various times in this presentation where we're going to talk about some of the professionals who can really step in and help out and add value. So again, where the rubber meets the road, we definitely want you to reach out and get very specific help. So just want to make that disclaimer right off the bat. Great. Yeah. And as mentioned, onto the agenda. So we're going to start off with introductions. I'm going to be passing it back to Mariah in a second. Mariah's going to introduce our presenters for the night. And actually, sort of more important, is also going to introduce Backflip to those who are joining for the first time. We're going to talk a little bit about what we're doing, about some of our products, which we're rolling out for investors. And then I'm going to take the baton from there and do kind of an overview of just the fundamental issues, just two issues in taxation that really are cross-cutting and are going to kind of lay the foundation. That's the Tax 101 section. We're going to be talking about timing and basis. And then I'm going to pass it back to Joe Latson, who's going to kind of go level deeper. And we're going to talk about how to structure your organization and how that could have real tax consequences. And we're going to talk about depreciation. And then Joe's going to pass it back to me for a conversation on 1031 exchanges. And then again, we have dedicated time for Q&A, but don't feel like you need to wait until the last agenda item to get your questions in. So with that, I'll pass it back to Mariah for the intros.
Awesome. Well, I am so excited to be able to intro my two amazing colleagues, Mike Toth and Joe Latson. Mike is our VP of Legal, very generously does a lot of these webinars, and I highly encourage you to utilize his 15 plus years experience and really utilize him as a resource throughout the session. And really excited to have Joe on his first webinar here to provide both the backflip perspective, but also he's an experienced investor himself, and so he's here to provide that firsthand experience. So thank you both so much for being here. and excited to launch into everything. For those that are new, and also those who are joining, excited to talk a little bit about Backflip. So Backflip is both a free app that helps investors to decide whether a deal is going to be a good investment or not. And then once you're ready, you can go ahead and apply for funding directly through the app. And so really cool way to be able to analyze properties really quickly. And it gives you a lot of insights into just what's going to be a good investment for you. So I'm going to actually do a super quick demo. For those who are already on the app, there's actually a new feature that I cannot wait to show you if you haven't already seen that. So let me go ahead and share screen really quickly. You'll see my screen come up here in just a second. All right, can y'all see that? Okay, cool. All right, so awesome, thank you. Yes, you can see me. Great, so I'm gonna go directly into the Backflip app, in which case you'll see these new widgets that show you actually how you can utilize the app. But most exciting thing that we usually like to show folks is analysis. So you can put in an analysis for anywhere in the country. I'm going to put in one that we did recently in Austin. And so let me go ahead and put in that address here. And what this is going to do is it's going to pull back all of the relevant comps in the area and really give us an idea about this property. And so in the top left-hand corner, you can see the estimated as-is value. And then in the center, you can see this after repair value. And so what's really cool about this is you can actually see how this is being sort of the algorithm is pulling all of this information together right down here on this comps. You can click view all, and you can actually see the properties that it's pulling from. So you can click into these, you can decide whether or not some of these are going to be relevant. You can check out the photos, you can see beds, baths, and if it is a relevant comp, you can actually push select, and it will add it to this comp. So as you can see, it changed that ARV in real time. And so this is a really interesting way to be able to analyze your properties. And then you can always dive a little bit deeper into how this is being calculated. You can click calculate, and then you can actually, see the analysis. So you can see this looks like a great deal. You can look at profit, you can look at ROI, and then you can always edit some of this information. So if you know that you can get this rehab for 40,000 instead of 69,000, you can actually see that changes the ROI and the ARV in real time. This is an analysis on fix and flip, but you can also click on the top right hand to change this to rehab and rent. So it looks like, from a rehab and rent perspective, this isn't the best deal, but it is from fix and flip. So really cool opportunity for y'all to do these analyses. I highly encourage you to do that. Once you're ready to go ahead and purchase the property, you can actually push on loans, get a loan, and then you can actually apply directly for a loan right through the app. It pulls up this analysis that we just did. So you can actually just quickly go through here, add in your personal information, and it takes about 3 minutes to do that. So really cool opportunity there. For those, actually for everyone, but for those who are already on the app, I really wanted to show y'all our newest feature. It just launched on Wednesday of last week, and that is called My Leads. And so My Leads is a really cool way for you to actually take your email, where you are potentially getting, wholesale emails from your realtor, essentially all of those addresses that are coming into your email that you have to kind of filter through. You can connect it directly to the app, define your buy box, and then it will actually pull all of those addresses into the app and do those analyses for you and give you that thumbs up, thumbs down. Saves so much of your time in terms of sourcing. And we're really excited about being able to do that. It's like I've seen it in real time, and it saves so much time when you're thinking about analyses. So Joe, you can jump in if you think I missed anything, but I'm going to post the link in our chat. So if you haven't downloaded the app already, please go ahead and do that. But yeah, really excited to dive back into taxes now that you've seen what the Backflip app looks like.
Wonderful, Mariah. Yeah, thank you so much. And it's a really a perfect segue into our discussion on taxes, because some of what you showed when you featured the analyzer tool are, the gains that investors can make when they invest in real estate, right? I mean, you put your kind of sweat equity, you put investment into a property, and with the market going up and the value of your investment and the value of your expertise, you can achieve a gain, right? But when there's a gain, oftentimes there's also a tax. And we're going to talk a little bit about what the taxes are and how different real estate investors address those tax issues. But really the place to start, in any conversation about taxes is kind of with the fundamentals. And I think, when most people think about the fundamentals of tax, they think about two things. They think about the tax rate. What am I going to pay? Is it 8%? Is it 10%? Is it 15%? Is it 0%? Is it 40%? What is the actual tax rate that I'm going to pay? Most people think, that is really where the rubber meets the road. And in a way it is. We'll touch on that in a second here. The other issue people really think about is, what does the tax code say? What is the particular language of the provision? So I'm going to hold up a book. Hopefully it'll make it into my camera. I found the biggest book that I could find in my library, and I just held it up, and it's probably 1/10 the size of the tax code, of the federal tax code. Federal tax code is enormous, and it has lots and lots and lots and lots of different provisions in there. And there are some provisions in the tax code that will lay out very clearly, this is taxable, this is not taxable, right? And that can be very important if you're engaged in that particular business and that particular issue comes up. But the reality is those two issues, the tax rate and the tax provision, aren't the timeless sort of fundamental tax realities that I think we should start the conversation around. And why is that? Well, think about tax rates. They change all the time. So we think about our federal tax rates. I went back and did a little bit of research, and this is probably not a complete list. 1981, 1986, 1993, 1995, 2001, 2008, 2017. What do they all have in common? The tax rates changed at the federal level in each of those years. And then at the state level, I mean, when we started off tonight's conversation, we saw people coming in who are on this webinar from Mississippi, California, Florida, all these different states. The state level taxes are changing. Tax rates are changing all the time. Again, a little bit of research here. 43 states changed their tax rates in 2021 and 2022. Some states changed their rates in both of those years. 21 states changed their income tax rates over those 2 years. A number of states changed their corporate tax rates over those years. So the rates will move around, based on, sort of the policy needs at that moment. So if we talk about rates, we're going to have a conversation that may be helpful this year, but it may be different next year. And you want to plan your business for several years ahead, right? And so we want to go a level deeper than just talking about the rates to begin with. They're obviously important, but they're important at the end of the story. We want to sort of cover the beginning of the story. Same issue with regard to the particular provisions. Again, those will change from time to time. What's deductible one year may not be deductible the next year, et cetera. And for those kinds of questions, and we covered this a little bit in the disclaimer, I think what we definitely want to do is get ourselves in front of a qualified, competent, experienced CPA, who's keeping a finger on the pulse of all the different tax changes, both at the federal level, and then if the CPO is operating and specialized within a different state, at that particular state level also. And a CPA can walk you through, where the ball ultimately landed with regard to particular provisions. Very important. But what I think we can talk about tonight to really kind of, lay the foundation to have a good, overarching view of tax is sort of the two fundamental issues that are timeless in taxation, which is timing and basis. So what are timing and basis? And we're going to have an example just in a few minutes here about basis. But let's talk about timing first. So what timing is when you pay taxes, when you realize the gain, right? So timing is really a question of when. And really the issue of when income occurred or when a profit occurred is really a fundamental issue. I think Joe and Mariah and I got together a few weeks ago and we planned to do this webinar, and Mariah was able to promote the webinar and send out the evite and do a lot of really great promotion about this webinar. And we've done this over the past couple of weeks. Well, between the time that we planned this event and the time that we're doing it, the US Supreme Court heard a major tax case. So just yesterday, there was a major tax case that got argued in front of our US Supreme Court. And really, at the end of the day, it's a case about timing. So there's a taxpayer who had invested in a company, and there was a law that was passed in 2017. Again, the tax laws are always changing. And this particular tax law affects undistributed profits for companies that are operating outside of the United States. So the question in this particular case is, well, if the profits haven't been distributed, is there really income? Is there really something to tax if they've stayed with the company? So the timing question is really what the justices on the Supreme Court were kind of diving into in this oral argument. And that's really the central issue in that particular case. It's going to come down to, when is the right time, when that income was really received, earned, recognized, realized, however you want to put it. So we're going to talk a fair bit, throughout this presentation about timing. The other issue, and we're going to turn to the example in a second, and then I'm going to pass it back to Joe, which is really, really important, is basis. So basis is kind of your starting point. When we think about taxation, taxation is taxation on a gain, on income or the increase of an asset, is what is ultimately taxed. It's that delta, that positive delta between where we started and where we finished, right? So where we started is basis. And, if we think about, wanting to limit our tax liability, the higher the basis, right, the lower the gain. Right. So, if you take an example where your basis is $100,000 and ultimately you realize a $200,000 sale, right? There's $100,000 of difference, we'll just call it, that could be subject to taxation. Well, what if in that same example, you were able to adjust your basis up from $100,000 to $150,000, right? Then what's taxable would only be the $50,000. That is the new difference between where you started with the 150 and where you finished with the 200. So really understanding your basis. What did you really put into the transaction? What did you really put into the project is really, really, really important. There's two other issues that Joe is going to touch on that kind of draw out the importance of basis. One is depreciation. So we're going to be using our basis to determine depreciation. And Joe's going to get more into exactly what depreciation is and how important it is for real estate investors. The other thing about basis is the importance of keeping accurate records. And that's also going to be one of the practical points that we're going to talk about when we get to the business organizations part of the presentation. So just last thing, and then we're going to turn to the example, and then I'll pass it back to Joe here. What's included in your basis? Right? So there are certain things that we can count as part of our basis, and there are things like your settlement cost, legal fees, real estate taxes. So if you purchase a property and you take the back taxes for the seller and you assume those back taxes and you pay those back taxes, that can be included in your basis. So again, we're increasing your basis. And so if there's a subsequent sale, if there's a later sale, right, now it's not just what you paid for it, but it's what you paid for it plus those taxes. And that goes up, and then the difference goes down, and the taxable amount may go down in your particular case. Owner's title insurance, recording fees. So these are some of the things that are included in basis. Loan origination fees, not included in basis, right? So again, and this is where the CPAs can kind of come in and sort of help you determine what's in and what's out. Really important, I think, for real estate investors, understand the concept, understand the importance of basis, understand where to go when there's technical questions, and always be keeping accurate records of what we're doing. So just to wrap up this kind of intro section, let's just flash the slide here. Okay, we've got an example. You borrow 175K and you put down 25K. Okay, so right off the bat, your basis is going to include the amount you borrowed, and it's also going to include your down payment. So $200,000 off the bat are going to be your basis. You pay an additional $3K in loan origination fees and $1K in legal fees. Okay, now, as mentioned before, the loan origination fees are not a part of your basis. The legal fees are. So sometimes we see in tax law that there's a lot of policy that's baked into tax law. So in this particular distinction, the code has taken care of lawyers. I don't know if that's a good thing or not, but they include our fees into basis. So if you seek legal advice in the course of a real estate transaction, that may increase your basis and reduce your tax liability, but the loan origination fees are not included. So you'd be up to 201. And then if you pay back taxes for the seller, that would also be included in your basis. So $211,000 of basis here. So again, the real important part of this is just to understand that basis can involve a few different parts of the transaction. It may not involve every dollar that you put into the deal, right? We think about things like loan origination fees, but it's really important to sort of, again, be seeking that CPA advice to make sure that you're calculating every aspect of basis to make sure you have the right starting point, so you're not paying taxes on, more than what you're obligated to pay taxes on. With that, Joe, why don't I send it back to you for BizOrgs?
Perfect. Thank you, Mike. Love that overview on timing and basis, and love how you touched on the importance of maintaining accurate records. That is key. Every real estate investor should really strive to maintain organized records of all things related to their transactions, their operating expenses, things like that, so that you can accurately hand over the correct documents to your CPA to help file your return in a timely manner so that they can maximize the results for you. Some things that I think are just like the basics of organization for investors. Strongly recommend opening up a business entity, whether that's an LLC or an S Corp, which we'll talk about, to both help to limit your personal liability, as well as avoid commingling business and personal accounts, income, expenses, etc. Opening up separate bank accounts for that exact reason too, keeping income and expenses related to your real estate business separate from your personal life makes everything a lot easier come tax time when you're handing things over. A lot of folks on this call are flippers, right? Or buy and hold BRRRR investors, might be STR, MTR owners and operators. So there's a lot for us to cover and something for everyone in this discussion. Mike, there are two things certain in life. What are they?
I was going to go with death and taxes, but, I probably want to maybe lean to like University of Alabama in college football, and and there being a special place in everyone's hearts for the UT Longhorns this time of year. No, in all seriousness, it's death and taxes, Joe.
I like it. I like it. And, similar to how there's certainty in death and taxes, there's also certainty in that everyone's tax situation is going to be different, right? So what we talk about today are high level examples and frameworks to follow, that, again, you should meet with a CPA to review and go through so that you can optimize your tax strategy for your business. So the first bit that we're going to talk about is going to be most relevant for the flippers on the webinar, right? That's a lot of the folks that we work with. And, house flipping is generally associated with active income and generating active income. So house flippers, because that act of buying, fixing, selling a house within a relatively short period of time is classified as active income. You're paying ordinary taxes on your net profits within a calendar year. The taxes that you are paying are federal income, state income, and also self-employment, right? So if we look at an example here, a flipper has sold 4 houses with gross sales revenue of $1 million, right? When you take out all of your expenses associated with completing and selling those properties, you end up with a $150,000 net profit. We're going to look at this from a tax perspective in two ways. One, as a sole proprietor or a sole member of an LLC, and then also as somebody that has set up an S Corp to help reduce some of their tax liability within the framework and legal, Mike, help me out with the word here, legal allowances of the IRS code. So let's talk about the sole proprietor first, right? So we talked about you're going to need to pay federal income, state income, and self-employment tax. You know, in this example, we're going to use a federal income tax rate of 20%, a state income tax rate of 5%, and a self-employment tax rate of 15.3%, right? So when you look at the math there, there's $150,000 times 20%, that's $30,000 in tax. Self-employment taxes. So the thing to remember about self-employment tax is that it's 15.3% up to $118,500. So there is a cap on it. It doesn't go for infinity. So if you are crushing it and you make $1 million, you're not going to pay that self-employment tax on the whole million. You're only going to pay it on the first $118,500. In this situation, 118,500 times 15.3%, that's $18,000 in self-employment tax. Then you have your state income tax, which is 5%. That's going to be your smallest tax burden for this particular year, and that's going to be $7,500, right? So we've got $30,000 going to Uncle Sam. We've got $18,000 being contributed through self-employment tax, and we've got $7,500 going to the state, right? So that's the sole proprietor situation. That total income tax is $55,630 in this example. So now you're wondering, is there a way to reduce my tax burden without giving up, the protections and benefits of, having an LLC, being the sole proprietor of an LLC and having my personal assets and liabilities protected? The answer is yes. You can set up an S Corp. An S Corporation gives you the same personal protections as an LLC. You can even own LLCs. You can even have an S Corp be a member of an LLC and an owner of an LLC if you are setting up, if say you own several different rental properties, but you're also doing flips, and so you want to set up an S Corp but set up different LLCs for your different rentals, you could do that and have your S Corp be the owner of them. So what's great about an S Corp and what's really important about an S Corp to qualify is that in the eyes of the IRS, if you set up an S Corp, you need to be paying yourself a reasonable salary, right? So for this example, we're going to pay ourselves a reasonable salary of $50,000. Something else that's super important within the eyes of the IRS, and I would say that this most ties to timing, as Mike was alluding to. It's super important to be making consistent payments for that salary, right? The IRS is going to be looking at your returns at the end of the year and see, were you making, recurring consistent salary payments to fit within, the requirements of maintaining an S Corp and to get this benefit, which can reduce your tax burden. What setting up an S Corp specifically does is it reduces your tax burden on your self-employment income tax. You will only pay self-employment tax on that $50,000 that you're paying yourself through the S Corp versus the $118,500. So in that example, right, where you were paying $18,000 in self-employment tax as a sole proprietor of an LLC, you're only paying $7,600, right? You're paying 15.3% on the $50,000. That saves you over $10,000 right there, just through setting up your business through an S Corp. All right.
Beautiful. And Joe, we got a question here from Christoph P. We buy another house in December for $150K and sell it in 2024. Okay, so yeah, this is a great timing question. So timing is super important, one, to determine sort of like when the gain occurs, and therefore, when the taxes are going to be due. And also timing can actually affect the actual tax rate, right? So, in this example, generally speaking, the tax is going to be due in the year where the sale occurred. So, if we have a scheduled close on a rehab property that, we've purchased, we've rehab, and now we're going to resell it to, the new buyer, and it's scheduled to close on December 30th, 2023. And, the deal gets pushed into 2024, even though, all the work was done in 2023, that's going to be a taxable event in 2024, right? So you'd wait until you filed your taxes for tax year 2024, maybe sometime in 2025, and you would deal with that gain then. Now, we're going to talk about tax 1031 exchanges and some things to do to even defer these tax gains, potentially well into the future. But one other point about sort of taxes that this question brings up, and great question, and obviously keep them coming, is the issue of a long-term versus a short-term capital gain. So, Joe, do you want to maybe talk a little bit about how the time that someone holds an asset can actually affect the tax rate that may be due?
Absolutely. Anytime you own a property for more than a year, it's a good thing because you are going to get a break on your taxable rate because you are being taxed at a long-term gains rate, which I believe is 15% still, versus a short-term rate, which is much, much higher. I want to say it is in the low 30s. Last I checked. But capital gains, short-term versus long-term capital gains, the delineation there is 1 year. So if you do end up owning a property for 1 year, more than 1 year, selling it day 366, you should be taxed at the long-term capital gains rate versus a short-term rate.
We had another question that came through in the Q&A. Does Backflip recommend a particular bookkeeping or accounting software? Example, QuickBooks.
QuickBooks is great. It's cost effective, it's dynamic, it integrates with your bank accounts, super smart, makes updating things and categorizing things really easy. It's probably your best bang, the best bang for your buck. And what most folks that you're working with on the CPA side of thing will be familiar with and helping you export the right reports and files.
Yeah, absolutely. Yeah, no, echo all of that. And we'll mention a couple names of other service providers as we go. And again, just to be totally transparent as we are at Backflip, we don't have like a referral network in place here with any of the folks that we're going to suggest that are worth looking at. We're all about community as one of our main kind of tenets at Backflip. And what community is things like this, people getting together and talking about what we need to do together to succeed. And kind of sharing ideas, et cetera. So, I think, yeah, in that vein, QuickBooks has got a really, really, really strong platform that is helpful for business operators across several industries.
Awesome. We had one other question. Can you do 1031 exchange on these flip properties? I know we have a whole section, so
we're gonna get there.
I love it. Absolutely. Yeah, we're gonna nerd out on 1031 exchanges. So we will
awesome.
We will double click on that.
Great.
Oops, I got ahead of the math there. Sorry about that, Mariah.
It's all good. All good. All right, we're good on that then as well.
Perfect. Depreciation. I love depreciation. It is not only something that really works towards your benefit as an owner of real estate, it's actually a requirement by the IRS to take it. Right. So you have to take depreciation on an annual basis on your investment properties. So how does it work? Right. So you own real estate, you buy it, right? You buy it on a set date, you buy it for a set price. This establishes your basis. So whether you're buying it turnkey and putting a renter right in, or if you're buying it, rehabbing it, refinancing it, and holding on to it, right? This applies specifically to real estate properties that you own for at least a year. You have to own the property for at least a year to take depreciation on it. So you buy a property, you make money owning that real estate through rental income. whether that's long-term, short-term, mid-term, etc., then you deduct large chunks of that real estate's value using depreciation. You lose, on paper, a phantom loss. You lose a significant amount of money on that real estate through these deductions that you're required to take on a straight line basis per the IRS. Those losses then offset the income generated from that property. And if there are losses on paper in excess of that income, that net income that was generated from that property, you can apply it to other investments or other sources of income, even active income, if you're a W-2 employee that also owns rental properties, etc. So the definition from the IRS of depreciation is a ratable deduction allowed over a number of years to recover your basis in a property that is used more than 1 year for business or income producing purposes. The IRS, right, allows you to depreciate residential properties over the course of 27.5 years. For commercial, the determined useful life is 39 years. So you depreciate it over 39 years. Residential is 27.5. Let's talk about a quick example of a residential property. I'm not the sharpest guy, so I like to keep math simple. Let's say that you buy a multifamily property, let's call it a fourplex in California, $2.75 million for a fourplex. You would then divide that 27.5 year, you then divide that by 27.5, which means you're deducting $100,000 a year in depreciation. So let's say that fourplex spits out $50,000 in net cash flow to you. So you've got $50,000 in income that you've received over the course of the year from this property, right? Come tax time, you're going to take that depreciation over that 27.5 year period, that $100,000, 50 less $100,000 is a net loss of $50,000. So you are effectively getting that $50,000 tax-free. You're not paying taxes on that income. In this situation too, say you have a W-2 or other investments that you have tax liabilities on, you can carry that loss and apply it to those other profits. It's a pretty amazing thing. Now, it's great, and there are ways to maximize depreciation and to maximize the mitigation of some of the taxes related to the income that you get from these properties. However, if you sell the property, right, there is a recapture of that depreciation at 25%. There are ways to avoid that, and there's a reason that, ironically, so many wealthy real estate owners live by the mantra of buy, refi, die, right? If you don't sell it, you don't pay back that recapture, you're dead, you're gone. It's an estate thing, right? So if you don't intend to just buy, refi, and die, you can also defer that recapture of depreciation through a 1031 exchange. This is a good segue to my good friend Mike to talk about 1031 exchanges, which is one of the best things within the IRS tax code for real estate investors.
I love it, Joe. I don't know what I love more, depreciation or 1031 exchanges, but I love them both. Just before I dive into to the 1031 exchanges, I love your last example with depreciation, because actually in that last example, death came certain, but taxes didn't. Right. So, you know, with effective tax planning, you actually may be able to defer taxes to beyond the point where you're still living. So, you know, with great tax planning, we can't take care of death. You probably need to kind of look elsewhere for that, but we may be able to sort of take care of, you know, deferring your taxable gains, you know, well into the future. Before also I get to the 1031 exchanges, just to double click on your points on depreciation, Joe, what happens in your depreciation example where you talked about the residential property? Let's just imagine that in year 5 or year 7, it was clear that the property was worth a lot more. And in fact, the property's market value had increased, let's just say twofold. So, the home buyer bought it at whatever they bought it at in your example, and they knew that the property was worth double. They used the Backflip Analyzer app. They compared it to recent sales in their neighborhood of really similarly situated properties. So what would happen in that case? Would they still be able to take depreciation, even if it was, pretty clear across the board that the property was actually worth more than what they purchased it at?
Absolutely. Market appreciation has no effect on your depreciation. The only thing that has an effect on your depreciation is your basis, right? That it's being depreciated based on, which was at time 0 when you bought the property. Your appreciation over time has no impact, which is a beautiful thing. Mike, one thing that I wanted to touch on too, that is one of the challenges that I think a lot of investors face, especially full-time investors that are living off of the rental income of their portfolios, right? So while it's great to minimize our tax burden, to take depreciation and to show a loss on our taxes each year, it can also make it challenging for a lot of entrepreneurs and real estate owners to get financing through traditional banks, et cetera, right? Because banks want to see income. They want to see stability. So when you show them your tax returns and they show a loss, even though you might have a massive net worth and great assets, they look at your income and you run into a DTI issue. This is one of the reasons that lenders like us exist, right? Because we don't look at that stuff in the same way that a bank does. But that is one of kind of the downsides that can affect real estate investors that are living off of their rental income from their portfolio solely. When they submit their tax returns to banks and they look at them, they're like, you're losing $100,000 a year. They just can't wrap their heads around how it's working and how to finance around that.
Yeah, great point, Joe. Well, I know everyone is now dying to hear about 1031 exchanges. So, without further ado, I'm going to give a few high-level points about 1031 exchanges. They are fantastic for real estate investors. And then we've got a few examples that we'll kind of dive into. But, as always, any questions, keep them coming. So, 1031, go ahead, Mariah.
Yeah, I don't want to steal your thunder, but we do have some questions that I hope we can answer really quickly.
Let's do it.
If you purchase a rental halfway through the year or convert it from your primary residence to an investment property, can you still depreciate it a full year?
I'd confirm with your CPA, but I believe that you would not take depreciation. Let's say you made this switch halfway through 2023. I think that you would take it in 2024 once you've completed the year of it being used for investment purposes.
Got it. And then can you have a holding company and get paid as a dividend instead of a taxable salary?
Better question for a CPA, to be honest.
All good.
Yeah, no, those are great questions. Yeah, it's sort of about the difference between kind of a salary versus a sort of a profit distribution. I'll just make a couple comments, but yeah, ultimately I would definitely, in these kind of technical questions, this is where the CPA comes in, but everyone is asking the right questions. The right questions come down to sort of biz org, basis, and timing. Sort of how do I organize and what are the consequences? How do I think about basis, depreciation, et cetera? And how do I think about timing? How can I defer taxes if possible, right? So these are the right questions. But yeah, I think what that last question is getting at is sort of the difference between a salary, which may be subject to employment taxes, and a profit distribution. So really great question. But yeah, definitely dial in with a CPA on that one. Really on 1031 exchanges, it really is about timing. And we're going to talk about how timing is everything for 1031 exchanges, kind of at two different levels. So, the first most basic level is, for the most part, generally speaking, when you sell an asset, you pay a tax on the gain. Okay, so if we're just talking about stocks, if you own, 10 shares of ABC Corporation and you sell it, and then you buy 10 shares of XYZ Corporation, right? You pay a tax when you sell ABC Corporation on any gain. And then when you sell XYZ Corporation, again, you pay another capital gains tax. Section 1031 of the Federal Tax Code provides an exception for, the general rule in taxation that you pay at the time of transaction. And it creates an exception for like-kind real estate exchanges. And if you do a like-kind real estate exchange, and we'll talk about what that means, you can defer the taxes. So 1031 exchanges provide a tool for deferring taxes. They're not tax-free, they're tax-deferred. And we'll talk in a couple examples about how you can kind of defer the taxes, way down the line by continuing to do 1031 exchanges. Couple additional details. We're going to get to the examples here in a second, which will allow us to kind of go into this a little deeper. One is the properties must be held for use for a trade or business or for investment purposes. So these are not, this is not like your primary residence that you can use for a 1031 exchange, right? I mentioned before earlier in the presentation, a fair amount of tax is policy, right? So the 1031 exchanges are really a very pro real estate investment policy. Not to get too far into the weeds, but the IRS and the Congress has changed the rules over time. It used to be that there are more assets, more kinds of things that you could do 1031 exchanges around. Now, real estate investment properties are really kind of front and center for 1031 exchanges. So they're still very much a part of 1031 exchanges. So we should think as real estate investors about taking advantage of this section of the IRS code. Yeah, go ahead, Joe.
And Mike, I would just say that it's a very, from a policy perspective, a very pro-growth, right? Because of the positive impacts that investment in communities can have. And so encouraging people to continue to invest and place money in different communities can have a positive net impact. And so I think that's one of the reasons from a policy level that it's been so popular.
Absolutely. It's the same policy that's behind the depreciation sections of the IRS code. Right. I mean, when Joe gave his depreciation example before, it's like if you're a long-term holder of this property, you get to sort of benefit from that depreciation over a really long period of time where your income is offset by that depreciation year after year after year for decades. And that policy is encouraging, the long-term holding of that asset. And with 1031 exchanges, again, we're encouraging real estate growth, real estate investment. Timing is everything continued, right? So we kind of covered how this is really important about timing because you can defer taxes. We're going to get into some examples about that. But timing is really important about 1031 exchanges for another reason, which is there's sort of a clock. There's a shot clock that's ticking in 1031 exchanges. So just to be a little bit technical here for a second, we're going to dive into the weeds just for a moment here, and then we'll pull back out and go over these examples. With a 1031 exchange, they're called exchanges because they really mean that there's an exchange between two different properties, like-kind properties. We'll talk in a second about what that means, but there really does need to be exchange. And what the IRS is sort of getting after there is the exchange from property A to property B needs to be dependent. Both parts of the deal need to be dependent on the other. So, it can't be that a person sells property A in the IRS's eyes, and then just in a completely independent, decision purchases property B. Well, how does the IRS sort of determine whether it's dependent or independent? And the way that they do that is they put some real time restrictions around it. So the property, and the easiest way to do a 1031 exchange is when a person simultaneously identifies the property that they're going to gain from the sale of the property that they're exchanging. You do have up to 45 days from the sale of the first property in order to identify the second property. So you've got 45 days. And then the sale has to occur in a 180-day time period. So there are some time requirements that are very strict, and the IRS really forces real estate investors to adhere to those. So what's the solution here? And then we're going to dive into the examples here in a second. Why do I bring up all these different dates and the timing sort of specifics around 1031 exchanges? It's not because there's going to be a test at the end of this presentation. And it's not so that, 2 weeks from now, people can kind of like think back and remember, oh, it's 45 days. It's more really to make more of a community point, which is, a very practical solution to sort of these timing requirements in the code for 1031 exchanges is to work with a qualified intermediary. And there are qualified intermediary companies all over the country. There's really large ones that deal with large investors, and there's ones that deal with local investors who are operating in individual communities. And so, one thing I think to really think hard about, and it's very similar to the point, we've made a couple times in this presentation about, finding a really good CPA who can answer some of these specific questions is, I would really recommend sort of like doing some research, talking with a couple qualified intermediary companies about the services that they provide, about their experience. It's going to be on you as the investor to sort of find the properties and find the right deals. But, the qualified intermediaries can really make the process work from a tax compliance perspective. So again, the takeaway and the deadlines, it's not so much that, we should be focused in on, memorizing sort of exactly what the rules require so that we can execute. Rather, it's just to know that there is some technical aspects to how we do this, but that's really where the qualified intermediaries come in and make sure that those timelines are complied with.
Awesome. Thanks, Mike. Before we hopped into examples, we did have another question, so I wanted to just jump in real quick. We talked about LLCs and sole proprietorship. So, with regards to opening an LLC, what are the logistics around moving the property from under your name to under the new business? Does the title move over? Do you need to notify your lender and move the mortgage over? If yes, could they force you to refinance?
In my experience, it's really going to come down to the language within your loan documents around transferability. So definitely a conversation to have. The quickest way, assuming that everyone's on board, is generally through a quit claim deed to transfer that asset from yourself personally to an entity. So really a conversation with your lender about potentially triggering any sort of default or loan terms change associated with transferring the loan to a different owner. And it would likely depend on who else is a member of that LLC too. Are you the sole member? Do they need to underwrite anybody new that might be associated with it? Things like that. So it's really a conversation with your lender specifically about that.
Awesome. Thanks, Joe. And Mike, back to you, back in the light.
Okay. Yeah, exactly. Yeah. Timing is everything. It gets dark at the night every day. So first example, rental income Rachel owns 100 acres of land. She sells the land for $500,000 and purchases a rental property for $400,000. Does this transaction qualify as a 1031 exchange? What amount is taxable, right? So, you may be reading this and thinking, well, okay, she's got land on the one hand and then a rental property on the other. That's, land plus a structure. How could that be a like-kind transaction? Well, the IRS says otherwise. So the IRS's view on this is, and I'm quoting from an IRS document here, most real estate will be like-kind to other real estate. For example, a rental property that is improved with a residential rental house is like-kind to vacant land. So, the like-kind requirement really just is a very broad requirement. Again, obviously consult your tax advisor in advance of doing any kind of exchange, but based on the current IRS guidelines, this would qualify, even though it's land for a rental property, as a like-kind transaction. And then on the other part, as to what amount is taxable, in this particular instance, rental income Rachel's only putting $400,000 into the exchange in terms of the second property, right? So she basically is sort of like taking $100,000 distribution outside of the 1031 exchange. So in that case, she may have to pay taxes if there's a gain on the difference, right? So, we're going to have a future example that maybe gives a way to kind of deal with this. But the traditional way of doing a 1031 exchange is to kind of purchase properties that are a real kind of exchange in an equal dollar amount of the property that's being relinquished. One for two. So Colorado Christina owns a 6-bedroom vacation rental property near a ski resort outside of Denver. She sells the property and purchases 2 3-bedroom rental properties on Lake Austin in Austin, Texas. Does this qualify as a 1031 exchange? Well, it does. So there's no requirement that the number of properties be the same in the exchange, right? So that might have been something that rental income Rachel from the first example could have benefited from. You can exchange one property for 2 properties or 2 properties for 1 property. Also, they don't have to be in the same state or in the same county or in the same neighborhood. The one restriction is the property cannot be located outside of the United States. So if like you're reaching for your passport, it's not going to be a like-kind exchange. So take a vacation after you do your like-kind exchange, but you can't purchase a property outside of the US. It could be identical in square footage in every other respect to the property you want to exchange for it, but it won't qualify under our rules as a 1031 exchange. Great. Okay, and this is our last example. And this one, Joe and I may tag team in part because we actually get to some issues of basis and some other points in this. So Lifetime Larry purchases a rental property for $100,000 at age 40. 10 years later, he exchanges a rental property for 2 rental properties for $500,000. 15 years later, Larry exchanges the 2 rental properties for an office building for $2 million. 20 years later, right? No tax presentation would be complete if we didn't talk about death at a couple points. Larry passes away and bequeaths the office building to his son, Lucky Lenny. 5 years later, Lucky Lenny receives an offer on the office building for $3 million. Lenny sells the office building and decides not to reinvest the money in a real estate investment property. How much taxes does Lucky Lenny owe? How much does Lucky Lenny owe in taxes? So, on this one, basically what happens with a 1031 exchange is that if you do 1031 exchanges for your entire life, and then you bequeath the property in a will, the person who receives it will receive what's called stepped up basis. So Lucky Lenny's basis in that property is not the $100,000 that his dad, Lifetime Larry, began with on this journey of 1031 exchanges. It's the $2 million or the amount that the property was worth at the time that it was bequeathed to Lucky Lenny. So you get stepped up basis, which is going to obviously reduce the tax liability for the person that receives it. I think one issue though to talk about here would be what would have happened if Lifetime Larry had sold the property for, let's say, $2 million right before he passed away. So in that case, we talked a lot about kind of like tax deference versus tax-free, right? So at that point, Lifetime Larry, his basis for that would be the $100,000. So he would then at that point pay taxation on the difference between the $100,000 that he originally put into the property and the $2 million. So that those taxes at that point would come due, but he would have deferred those taxes for the entire, the entirety of the 1031 exchange.
Amazing. Well, I know that we're right at a little bit over time, so I want to give people the opportunity to ask any final questions of you both. This has been super informative and very both a good balance, technical and high level. So if you do have any other final questions, please go ahead and post them in the chat. Mike and Joe, any last thoughts you want to leave folks with?
Timing and basis, that's all I got.
Anything from you, Joe? Okay, cool. It looks like last question. Any good books that you would recommend for flippers about taxes? Oh, I love this. Any recs?
That is I think yeah, great question. I would really, I can't think of any particular book, but I would definitely, there's a lot of literature online about 1031 exchanges. And I would highly recommend, just spending an afternoon just sort of reading up on 1031 exchanges, because, they really are a great vehicle for real estate investors. And a lot of the materials will also kind of have recommendations about different strategies and qualified intermediaries and kind of ways to sort of make 1031 exchanges work for your situation.
I think similar to so much in kind of the real estate journey that everyone's on, talking with peers that you really trust and look up to, I think is also a great first step, and just getting some of their real life anecdotes and any recommendations on CPAs that they've worked with and that really have a strong background in real estate specifically, because there's a lot more beneath the surface of what we even touched on today. And again, just a reminder that everyone's tax situation is unique and different. So there's a lot of great resources out there to help give you a broad overview, but for your specific situation, you should really talk to a CPA about maximizing it.
I love that. It looks like Christina posted, she's it sounds like she's got about 30 plus years experience in accounting and all that. So reach out to her. Thanks for sharing your info, Christina. I'm going to share my email as well if you want to reach out to us, the Backflip team. And thank you so much for being here. We'll have another presentation next week, so hopefully see you then. Thank you, Mike and Joe. Talk to you soon.
Thank you, Mariah. Thank everyone for joining. This is great.
Thanks all.